Hello bro, and welcome back to the new stock evaluation video. Today we are going to analyze this extremely famous company called Accenture PLC with the stock ticker ACN. And as always, we are going to analyze the company using this little Canva presentation that I prepared right now here. And let's go straight into it, okay? Now, why should you listen to me? It's very simple, bro. My name is Yasha and I am your best stock advisor who will help you make smart decisions on the stock market, okay? This is me right now here. And additionally, bro, I know quite a few secret strategies that will help you outperform the SP 500. So if you are interested in that, click the first link in the description. Now let's go straight into the analysis. This is going to be very simple, straightforward, beginner-friendly analysis without some bullshit talking just like your professors do on your business university who are broke and absolutely useless, okay? Now, generally, here are the things that you should care about, especially if you are a beginner on the stock market. Those are chart, profit, debt, money on the bank account, value, and price. Now, let's begin with the chart, okay? So here, in terms of the chart, we have a little instruction saying that chart has to grow for all 10 years that we analyze, okay? Now, what should we do right now here? We will first draw a little exponential line right now here, kind of like this. And then we will compare the actual chart with that line right now here. Now, generally, the chart has to follow that line. So let's take a look at it together, okay? Now, we can see that the chart here was growing and then also following the line right now here. But then it was kind of falling down and then going up again and now slightly falling. But generally, bro, the chart follows this exponential growth line. So chart is good to go, okay? Now we come to the profit. And for the profit, we also have the very same instruction. For example, profit has to be in plus and it has to grow for the all years as well, okay? Now here we will do the exactly same procedure just like with the chart. We will first draw a little exponential line, kind of like this. And then we will compare the profit or net income. Basically profit is the same as net income. We will compare them with that exponential line, okay? And we can see that the profit also grows as same as this line. So here profit is also good to go. Now we come to the debt, and the instruction for the debt is that debt has to be low and it has to decrease through the years, okay? Now what do we have here? We can see that firstly the debt was decreasing until 2020 and then they had a massive debt, probably because of COVID crisis or whatever, and now it started to decrease again. So generally the debt is decreasing through the years, but here in 2020 it was growing up massively, you know. So here I was a bit in a doubt, what should I do? But with the analysis we have to be as strict as possible, okay? So even though the debt is decreasing in both periods, it's still here in 2020, it was still higher, you know. So that's not a good sign because they increased the debt. Even though it's falling, even though here in 2014 to 19 it's falling, but still, bro, the debt is higher right now. So that's not a good sign, okay? Now we come to the money, and with the money, I mean money on their bank account. And generally, bro, money has to be higher than the costs. Now, how can we decide whether money is higher than costs? It's very simple. We just take a look at the money right now here. So altogether, they have $8 billion on their bank account. And you can see that this is actually here in plus, which means that money is higher than costs. So that's a good sign, bro, because whenever they have to pay something, they have money, it's quite obviously. So money is also good to go, okay? Now we come to the value, and for the value, we generally have to think about the stock that is undervalued, okay? Now, how can we decide that? We can decide that by measuring two different things, which is P/E ratio and intrinsic value. As a rule of thumb, P/E ratio has to always be lower than 15. Now let's take a look at the P/E ratio of Accenture. It's around 27, which is actually higher than 15. So that's not a good sign. Now we come to the intrinsic value, and intrinsic value is actually the fair value of that price. Now, what does that mean? the Accenture stock right now, based on some complicated calculations, should have this price right now here. The price of the stock should be at this exact moment $293 based on the fair value. You know what I mean? But the current price is 308, which is, I think, around 23 euros higher than the fair value. So that's not a good sign, okay? Because intrinsic value right now, it's lower than the current price. But actually, it should have been the opposite. Intrinsic value should be higher than the price, okay? So here, this is also not a good sign. Now, your question might be, how can you find the P/E ratio and intrinsic value? P/E ratio you can find, for example, here in this website called Ticker Terminal. It's right now here. But the intrinsic value, bro, you don't find here on that website. So you just have to type in Google Accenture stock intrinsic value and you will find it. It's very simple, okay? And now we come to the price. And here we also have a little rule saying that the price has to be lower than 150 euros or dollars or British pounds, whatever. I am from Europe, we have euros, okay? So for me, it's 150 euros. Now the current price is 308, almost $309. So that's above 150 euros, which is not a good sign, okay? We want to buy stocks that are cheap and also undervalued, okay? Now we come to the final evaluation, bro. We have it right now here. And we will basically just summarize everything that we found out at the moment, okay? So chart, does it grow? Yes, it does. If you don't believe me, go back a few minutes and you will see the analysis, okay? Does the profit grow? Yes, it does. Oops, that's a bit too big tick. Wait, what's happening? Okay, yes, it does. Debt, is the debt decreasing? No, it's not. You can also take a look at that. Do they have money on the bank account? Yes, 8 billion euros. Now the value, is the stock undervalued? No. And is the price below 150? No. Now we have 3 buys, or let's say 3 times yes and 3 times no. So what is now the last summary, bro? We should technically sell this stock, but you must not consider, bro, that this stock is very famous. Like Accenture will not go anywhere whatsoever. I also made a detailed analysis of this stock and they are investing a lot of money back into the company. They are paying dividends. The company is growing. The only problem actually is that they increase the debt, even though the debt is also decreasing. But they have more debt right now, probably because of the COVID. But generally, bro, it's an amazing stock, an amazing performance, very famous company. The only problem is that it's a bit overvalued. So in my opinion, bro, you should put this stock at least on a watch list if you are interested in it. And then maybe when the price goes a bit down, then buy it, okay? You can also buy it right now, but don't buy it with some significant highly amounts, like, I don't know, 5,000 per day or something. Start with small positions, maybe 100 euros per month or something like that, you know. Do your own analysis as well. Think about it, how much you like this company, what do you know about it. But generally, bro, you should at least put it on your watch list, okay? Now, if you want to know more about stock market analysis, if you want to know more about the money, join me on my journey, click subscribe. I want to improve myself with stock market. So now you know what to do, bro. Do the hard work and see you on top of the world.